So the general objective today is to help you understand how to determine when distributions from a Roth IRA could be subject to income taxes and the 10% early distribution penalty. We're going to cover several topics, including source of funding for a Roth, because that is important to the income tax and or penalty determination. We're also going to look at 2 5-year rules, which is the part of the crux of determining whether or not a distribution from a Roth IRA is subject to income tax and penalty. We're going to define qualified distributions and, of course, in the same vein, non-qualified distributions, and look at the very important ordering rules that apply for distributions that are non-qualified. So, of course, let's start by defining the basics. What is a Roth IRA? A Roth IRA is, of course, the IRA stands for Individual Retirement Account, is a retirement account that is established by an individual. Now, there are several options for funding a Roth IRA, which includes regular contributions, rollovers, Roth conversions. And of course, income limit applies to making contributions to Roth IRAs. Now, I find that many individuals tend to forget that the income limit applies to making contributions to Roth IRAs. Why? Because you may recall that in 2010, the income limit that applies to Roth contributions were repealed. Before that, an individual couldn't make a conversion, I should say. Before that, an individual could not make a conversion to a Roth IRA if the individual's modified adjusted gross income was over $100,000 and if the individual's tax filing status was married filing separately. Those restrictions were repealed effective January 1st, 2010, and as a result, anyone can now do a conversion to a Roth IRA. Now, because those rules were repealed, those restrictions were repealed, some individuals mistakenly believe that the income limits on contributions were repealed as well, but that's not the case.